Fed's money flood. Why rate cuts are off the table. The Federal Reserve's monetary policy plays a pivotal role in shaping the economic landscape. By adjusting interest rates and overseeing the nation's money supply, it influences inflation, employment, and overall economic growth. Its actions are closely monitored for their far-reaching implications on the economy. Pumping money into the economy is a strategy the Federal Reserve employs to stimulate economic activity. This involves increasing the money supply, making funds more accessible to banks, businesses, and consumers. The aim is to encourage spending and investment, which in turn fuels economic growth. Historically, the Federal Reserve has resorted to injecting funds into the economy during periods of financial distress or recession. This approach seeks to mitigate the effects of economic downturns by providing the liquidity needed for financial institutions and markets to function smoothly. Interest rates are a critical tool in the Federal Reserve's arsenal for managing economic growth. By lowering rates, borrowing becomes cheaper, encouraging spending and investment. Conversely, raising rates can slow down an overheated economy, helping to control inflation. The decision to pump money into the economy is driven by various factors, including the need to combat recessionary pressures, boost employment, and ensure stability in the financial system. Such measures, while necessary, are carefully calibrated to balance short-term benefits against potential long-term consequences. The immediate effects of the Federal Reserve's decision to increase liquidity in the market are multifaceted. Enhanced liquidity typically leads to lower interest rates, making borrowing more affordable for both individuals and corporations. This accessibility to cheaper credit fuels investment and consumption, potentially spurring economic growth. Understanding the relationship between pumping money, inflation, and interest rates is crucial. When the Federal Reserve injects money into the economy, it can lead to higher inflation if the increase in money supply outpaces economic growth. Consequently, managing interest rates becomes a tool to temper inflationary pressures. The long-term implications of the Federal Reserve's monetary policy are significant. While short-term boosts to the economy are often positive, sustained low interest rates and high liquidity can lead to challenges. These include asset bubbles, where the prices of assets like stocks and real estate become inflated beyond their intrinsic values. The concept of too much money circulating within the economy brings its own set of consequences. Excessive liquidity can diminish the value of money, leading to inflation. This situation erodes purchasing power, making everyday goods and services more expensive for consumers. Exploring the Federal Reserve's limitations in cutting rates after an extended period of pumping money reveals a complex scenario. Once rates are near zero, the Fed's ability to stimulate the economy through rate cuts is significantly reduced, requiring alternative strategies such as quantitative easing to influence economic activity. The Federal Reserve's actions significantly impact both average consumers and investors, infusing the market with liquidity to stimulate spending and investment. This intervention can lower borrowing costs, making loans more accessible for purchasing homes and starting businesses. In preventing economic crises, the Federal Reserve employs monetary policy as a shield. By adjusting interest rates and the money supply, it aims to mitigate the effects of economic downturns, ensuring stability and fostering confidence among consumers and businesses. Pumping money into the economy, while often necessary as an economic stimulus, is a complex maneuver. It seeks to energize stagnant markets, but requires careful calibration to avoid overheating the economy and fueling inflation. Balancing economic growth and inflation presents the Federal Reserve with a formidable challenge. Too much liquidity can lead to inflationary pressures, whereas insufficient intervention may result in underemployment and slow growth, highlighting the nuances of monetary policy management. The global implications of the Federal Reserve's monetary policy decisions extend far beyond U.S. borders. As the dollar plays a pivotal role in international trade, changes in U.S. monetary policy can influence global economic conditions, affecting trade balances, investment flows, and exchange rates. The debate over the Federal Reserve's approach to managing the economy is multifaceted, reflecting diverse perspectives on its interventions. Critics argue that excessive manipulation distorts market mechanisms, while proponents believe in its necessity for stability. This discourse shapes the narrative around monetary policy effectiveness, highlighting the complexity of economic stewardship. The Federal Reserve's actions directly influence banking systems and lending practices, altering the landscape of financial accessibility. By adjusting interest rates and liquidity, it aims to foster an environment conducive to economic growth, though the outcomes are scrutinized for their broader implications on financial health. The risk of creating asset bubbles looms large with the Federal Reserve's infusion of excessive liquidity into the market. This concern underscores the delicate balance between stimulating economic activity and inadvertently inflating asset prices beyond sustainable levels, posing a significant challenge to monetary policy execution. A growing dependency on Federal Reserve interventions has sparked debate about the long-term sustainability of such measures. Critics warn that continuous reliance on monetary policy as a tool for economic stimulus may limit the market's natural corrective capabilities, leading to a cycle of dependency that is hard to break. Quantitative easing, a strategy employed by the Federal Reserve, plays a pivotal role in its monetary policy arsenal. By purchasing government securities, it injects liquidity into the economy, aiming to lower interest rates and stimulate borrowing and spending. However, the effectiveness and repercussions of this approach continue to be subjects of intense analysis and debate. The Federal Reserve strategy, often characterized by quantitative easing and interest rate manipulations, starkly contrasts with other central banks' approaches. Globally, these institutions employ diverse tactics, reflecting their unique economic landscapes and policy outcomes. The impact of the Federal Reserve's monetary policy extends beyond domestic borders, influencing the U.S. dollar's value. A robust dollar can exert significant pressure on global trade dynamics, affecting import and export balances across nations. Criticism and support of the Federal Reserve's management of the economy are widespread, underscoring the complex nature of its role. Advocates argue that its actions prevent deeper recessions, while detractors warn of long-term inflation and market distortion risks. Fiscal policy plays a crucial role in complementing the Federal Reserve's monetary policy. Effective coordination between these policies can enhance economic stability, promoting growth and mitigating unemployment without overheating the economy. Withdrawing pumped money from the economy presents challenges, requiring careful calibration to avoid triggering market volatility or economic downturns. The Federal Reserve must navigate these waters delicately, ensuring the withdrawal does not undermine the achieved economic stability. The Federal Reserve meticulously monitors a plethora of economic indicators before deciding to cut rates. This careful observation ensures that any adjustments to interest rates are timely and aligned with the broader economic goals of stability and growth. Market reactions to the Federal Reserve's monetary policy decisions are crucial. Positive responses can bolster confidence and stimulate investment, while negative reactions may necessitate further interventions or adjustments to maintain economic equilibrium. A sudden decision by the Federal Reserve to cut rates after an extended period of pumping money into the economy could lead to a myriad of outcomes. Such actions might stimulate borrowing and spending, but also risk inflating asset bubbles or undermining the value of the dollar. Transparency and clear communication from the Federal Reserve regarding its policy decisions are paramount. Effective communication helps manage expectations and reduces market volatility, ensuring that stakeholders are informed and can act accordingly. Maintaining a delicate balance is essential for the Federal Reserve in its dual mandate to foster economic stability and growth. Through judicious use of monetary policy tools, it seeks to navigate the complex dynamics of the economy, aiming for sustainable progress.